Welcome to the Bourbon Friday show, where every week we take a short break, try a new bourbon, and meet somebody awesome from the St. Louis startup scene. I'm your host, Nick Niehaus, and I'm very excited today because I have Brian Matthews, the co-founder and general partner of Cultivation Capital. So Brian, first of all, welcome to the show.
Well, thank you, Nick. Thank you for having me. I'm excited to be here.
Yeah, thanks for joining us. So let's just start with something simple. What is Cultivation Capital?
Cultivation Capital is a venture capital fund located here in St. Louis. It's a series of funds focused on a number of different industries and a number of different stages within the ecosystem here in St. Louis.
Okay, cool. So let's just start by, obviously, I think a lot of people, when we talk about venture capital, the first question is, how do I get some of that money, right? So how do you choose some of the companies that Cultivation Capital invests in?
Well, first we look at a lot of companies, and
Sure.
and we have a number of different stage funds. We have business development funds or accelerators, 630, which is fintech, 630 cyber, Yield Lab. They have a different parameter for decisions. And then we have life science funds, and we have ag tech funds, and then we have software technology funds. And I'm one of the managing partners on the software technology fund. And we are looking for companies that have $500,000 to $2 million in annualized revenue, and they're growing at 10 to 20% month over month.
Gotcha. Okay. And these are, I know you mentioned before the show, it's kind of the pre-seed or seed stage is kind of what you're looking for versus Series A. So what's the mentality there? Why do you go for those smaller companies?
Yeah, so this has kind of changed over the time that we started. Cultivation started in 2012.
Okay.
But A-round funds have continued to get larger and go to a little later stage. And today, an A-round fund is about $5 million in annualized revenue in the software space. We participate in this $500,000 to $2 million, and we provide capital over a number of years until they get to that $5 million in revenue or beyond. And the reason why we have decided to play or invest in this earlier stage is because there's less competition. There's less funds that play in this marketplace. We're usually competing with angel groups as an investor. So we're getting in a little earlier, and we can usually get a better valuation on the company.
Sure.
A-round funds tend to have a little bit more competition, and maybe we'll have to pay a higher valuation. So we're getting in a little earlier. The reason funds don't want to do that always is they're a little bit more work. We take a board seat and we get into these companies earlier, and we're helping them build their team and doing a little bit more work maybe than an A and beyond venture fund.
Gotcha. So you're kind of more of a mentor role, it sounds like.
I would say there's a little bit more mentorship going on at that time. These companies can be as small as 5 or 6 employees when we first make an investment.
Sure.
And they'll get to 30 or 40 or beyond when they get the A-round fund.
Wow. So yeah, that's a pretty big transition. Okay. So one thing you mentioned, you talked about angel investing versus more of a venture capital approach. And so since you're going up kind of against some of these angel investors, tell us a little bit about what's the difference between what you call an angel investor versus something like Cultivation Capital.
Yeah, all angel groups are different.
Sure.
And there's not necessarily competition between an angel group and a venture fund. We might lead a $3 million round with $1.5 million of our own capital, and we need to fill the other $1.5 million. And so if the founder doesn't already have that money soft circled, we will introduce them to some of the angel groups here in town. Angel groups have a similar process to us, but it's our full-time job, and for angel groups, it's typically not a full-time job. So I think our processes are just more intense. We look at more deals. We'll look at 12 to 1,500 deals a year.
Really?
And an angel group is not going to see that many deals.
Sure, I would imagine.
But we do not view angel groups as competitors at all, but cooperative investors alongside of us in many cases.
Gotcha. So that's a lot of companies to look at, almost 1,500 you said. What's that process look like? Do you have who's working on these, and how do companies approach it to be considered for something like that?
Yeah, so we have a principal assigned to every single one of our funds, and it's their full-time job to look at deals and start to cull through the process of finding good opportunities that they present to the general partners. The general partners meet on a weekly basis, and those best companies that they have seen in the last week are presented to us. And if they're interesting to us, we will continue to do more due diligence and research on those companies. But a principal needs to look at about one company a day. And so, that's quite a few companies over the course of the year. And we have 13 back office people. And so most of those, not every one of those, but most of those are looking at probably 5 companies a week.
Wow. Okay. A lot of work, it sounds like.
We look at a lot of companies.
Yeah. Okay. So I know one thing we were talking about earlier was the fact that you don't invest in companies that have zero revenue, or typically don't, right? So why, I think a lot of people, that are thinking about how a company raises money, like we have this idea that you build this amazing product and then somebody gives you millions of dollars and then you go out and try to, sell it to people. Sounds like that's not quite how this works generally. So why not invest in just an idea or a company that hasn't quite made any money yet?
So every dollar and every customer reduces the risk of the investment.
Sure.
And we see great ideas with zero revenue. What we don't know is, will the product work?
Sure.
Does the customer want it? Are they happy with the quality and the vision of the idea? And so the farther they go along, the less risk in the deal.
Gotcha.
I wouldn't say we don't invest in zero revenue companies. We have, and we will continue, but usually those companies are serial entrepreneurs, founders that have done it before, have more of a track record and that we have the confidence in that they can do it again.
Sure. So I know you mentor a lot of people that are kind of at that early stage. So somebody's out there and they have an idea, maybe they started working on it, but they haven't sold it at all yet. Any advice on kind of the next step before they start looking for money at all, or other than just go sell something,
Yeah. So, I think the longer you can stay fully or gainfully employed while you work on your idea, the better.
Sure.
And that's certainly what I did in my first company. But friends and family is usually the first place you go. Credit cards, home equity loans.
Fair enough.
Ultimately, if you get lucky or you work through the process, you can get an Arch grant.
Yep.
You get in front of the angels.
Sure.
There is a pretty good continuum of capital here once you start to show some kind of progress, even if it's not customers. That can get you along the way and start getting you closer to cultivation capital.
Gotcha. Okay, cool. So that leads me to a little bit of a transition and questions here, which is you mentioned your first company. And so I want to ask you a little bit about that experience. And if I understand this correctly, this is all about fantasy sports, right?
Yeah, that's right. So I started my career at McDonnell Douglas back in the 80s and was playing a game that ultimately was fantasy sports. I don't think we knew it was fantasy sports when we were playing it. It was actually before there was a fantasy sports industry.
All right.
And
it's hard to imagine at this point. I mean, it's such a big deal nowadays. Yeah.
It is. And so we were playing these games on company assets because there wasn't PCs at that time.
Sure.
And so at work is where we usually kept track of our statistics.
Gotcha.
As we played these games, and of course there was no internet at that time. And so it was all over the phone, and we would get the newspaper from the USA Today and type in the stats.
Oh, wow. Okay.
And that's where the cottage industry of fantasy started. And then in the late 80s, of course, Macintoshes and PCs started coming along.
Sure.
And my wife and I, who I had met at McDonnell Douglas, started working at home on programs to manage fantasy sports companies.
Really?
And in 1991, we started getting serious about starting a fantasy sports company, and my wife first left. And in 1992, we made a deal with the Sporting News, and we launched our first fantasy sports game, Sporting News Fantasy Baseball Challenge in 1992.
Wow.
And by May of 92, I had left the company as well. And that was how we first started.
Wow.
we were lucky. There wasn't much competition in the marketplace.
Sure.
We had the Sporting News as a marketing partner, so we were able to get the word out on the company, and we were profitable in our first year.
Really? Wow.
And obviously that's a pretty rare thing, but that helped us quite a bit.
I bet, yeah.
And by 97, 98, we were the largest fantasy sports company in the country.
Wow, okay. So you eventually sold the company, right?
So there was a change in the industry. The internet came along.
Of course, yeah.
When we started in 92, we had a 100-person call center that answered the calls, and we would send out between 50 and 100,000 pieces of mail a week.
Wow.
To communicate with our customers. And in 95, the internet came along, and everybody started transitioning to the internet, which kind of broke up our monopoly, if you will.
Sure.
Because Yahoo and ESPN and what's now CBS.com started competing in the marketplace with us.
Okay.
And we had to make that transition to the internet.
Gotcha.
And we made that transition, started an internet company called Primary Network, and ultimately built our fantasy sports company and sold it to a company called Liberty Media in 2006.
Okay.
So had that company for about 15 years.
Very cool. Yeah. So tell me about, I know you've had a couple other companies since then or during that time. What else have you done in your background before getting into VC?
Yeah, so Primary Network was interesting. We needed to get on the internet, and so did Sporting News. And Sporting News at that time was located in St. Louis.
Okay.
And I had some experience with ARPANET, which was a defense internet that had existed when I was at McDonnell Douglas. And so I was familiar with that. And so we decided to build our own internet company.
Really?
And Primary Network became an ISP here in the Midwest. And it was my first foray into venture capital because we ended up raising $53 million.
Wow, okay.
And to build out our internet company. And so I was on the receiving side of the capital.
Gotcha.
And had experienced that process. And ultimately sold that business in 2000 to a publicly traded company called Empower Communications.
Wow, very cool. So it sounds like you just kept solving your own problems by starting new businesses.
Yeah, I think a lot of times you see that with serial entrepreneurs.
Sure.
Within their one business, they see another problem that causes them to launch another company. Jim Eberlin here in town is a perfect example, having launched Host Analytics and then Gainsight and now Top Ops.
Yeah.
And all of these ideas came about from solving problems that he experienced in his previous company.
Gotcha. Okay. So let me ask you this. Does it get easier with each one? Do you, I mean, I know they're different businesses, obviously.
It doesn't get any easier. No. Starting at the beginning and building the team and creating the product and getting the revenue is always a grind.
Sure.
There's no shortcut to that.
Sure. Gotcha. Well, another kind of similar question. I know you mentioned that you started the business with your wife. So what was that like? I know a lot of people out there, the idea of kind of the mom and pop shop, I feel like is dying out a little bit nowadays. So what is it like working with your spouse on a business?
That doesn't work for everyone, obviously.
Of course, yeah.
And my wife Carol and I had met at McDonnell Douglas, and we knew how to work collaboratively in the work environment. And so I think what made us successful is that she's very operationally focused, very detail oriented. And I was more of the idea person, maybe more of the sales person.
Sure.
Even though I had an engineering degree, I had a little bit more of that in me. And so we meshed pretty well.
Huh.
And if you're married, starting a new company is a grind.
Yeah.
And they kind of want to see you from time to time.
Sure.
And, having founded the companies together, we were in offices right next to each other. We could see each other during the course of the day. So there wasn't the pressure of going home.
Yeah.
So that can be good and bad. I mean, we would work 17-hour days quite often.
Wow.
But that's what made it doable. It's hard for a founder who's married to pull it off because of the pull of the family life.
Sure, especially if you have young children, I imagine, right?
It's very hard.
Yeah. So I know one of the things you mentioned there is obviously having kind of different skill sets. And I think, from the conversations I've had with my friends, I think a lot of times people think you should start a business with someone like you because you'll get along, you have similar ideas. But it sounds like maybe the idea is to find someone who's got a kind of a different skill set or different take on things. Are there specific skills you think are really essential to starting a company, or kind of co-founder you should look for?
Yeah, so I've thought about this a lot. And why did we have 4 successful companies, and why did we have 7 or 8 failures?
Yeah.
And what were the things that made them work? And it really is the co-founders. Having 3 or 4 co-founders that are different and plug gaps in the skill set
Sure.
Reduces the load of the amount of work that each founder has to do. And usually, if there's 1 or 2 founders, they're filling holes that maybe they're not the right person to do in the beginning.
Gotcha.
And so, yeah, I think there's at least 3, if not 4, skill sets that you should look for in your senior management team and in the beginning as co-founders. And that would be a technology person. That would be a sales and marketing person,
of course,
and an operation person, a detailed person. And those 3 skills usually do not overlap.
Yeah.
A technology guy is usually detailed in operation, but he or she's pretty much into the technology.
Yep.
So an operations, a salesperson, and a technology are the 3 cores of a founder. If you have 2 founders that are very similar, that tends to cause friction because you disagree on ways to attack problems.
Gotcha.
So it's better to round out your team no different than a sports team and getting a good mix of skills.
All right. Yeah, it's a good analogy. Play your position, right?
Exactly.
So is that something when you're investing, or are you looking at that aspect? Like, do you like to invest in companies with multiple founders, or is that part of the strategy? Or?
We would. Ideally, we would like to see 2 or 3 founders within a company. A single co-founder is tough to succeed.
Yeah.
There's too much work for one person. And I have just found by giving other people a co-founder title, even if it's a year or 2 after you have founded the company, saves you money.
Okay.
Co-founder title allows you maybe to pay them less, and you don't have a lot of money in the beginning, as well as calling them a co-founder makes them think like an owner. And you always want your early employees, you want all of your employees, but your early employees in particular, to think like an owner.
Yeah.
And by giving them that co-founder title, it achieves those things.
Helps them. Yeah, okay. Cool. All right. Well, let's talk a little bit about the bigger picture here in St. Louis in particular. And I know that you, I think, had some involvement in working on the report that the Chamber of Commerce put out recently about kind of the state of venture capital and funding. And I know one of the things that came out of that was this kind of idea of like the valley of death, right? So can you explain to us, what that is in terms of companies raising money and how that all works?
Yeah. So the valley of death is always in the early stages. When you're a company with $2 to $5 to $10 million, you're never going to have problem raising money if you want it.
Okay.
Right. There's a lot of money out there, and when you show traction, you're going to get it. So the valley of death is in the very beginning when you've got the idea, you've got the product, you need to hire a sales team to sell that product. And finding that money is the hardest part.
Okay.
And it's no different in St. Louis than it is in any city, except for maybe the Bay Area, Boston, and New York. But the Valley of Death is early stage capital.
Gotcha.
And what we've seen, we were probably more successful 3 or 4 years ago, writing smaller checks, and Cultivation Capital was writing smaller checks 3 or 4 years ago. And what we have seen in the numbers is that we're writing more money, investing more money into less companies. Okay. And so I think last year's number was $300 million, give or take, in less companies, and an average of $7 million per investment per company, versus a few years ago was $2 million into more companies. And so it's not that surprising. So we invest in 50 companies. 2 years from now, those 50 companies are looking for larger amounts of money.
Of course.
And if there's not enough capital in a city, it ends up going to the ones that are farther along. It's a natural philosophy that they're safer the larger they are. And so we're in a situation right now where we've got quite a few good companies in the late seed, maybe even A round, but a lot less companies in the early seed that have received money. We have more companies now than ever, 750 to 1,000 here in St. Louis that are out there in various stages. Wow. So we have a really good pipeline and not enough capital in that early stage.
Gotcha. So how does that get addressed? I mean, is this about the bigger companies eventually exiting in some way and getting that money back so we can put it into the smaller companies?
No question, that helps. Yeah, that helps. A lot of our investors and a lot of our angels are have a lot of capital already deployed, and as exits take place, most of the time they reinvest in that money into other companies, and so there's that. But there's a lot of money on the sidelines here, and it's an educational process to convince the investors that are out there that this area of investment, alternative investing, is not as risky as they think. And it's an educational process. So the angel groups here in town, Cultivation Capital, are all trying to educate more investors to raise more money. There's a lot more capital to be raised in St. Louis.
What needs to happen to I mean, I say education. I mean, is this just that they just don't know how it works, or are they afraid of something in particular?
I think the general opinion is that these are very, very risky investments. And certainly there is more risk to these investments. But I know Arch Grants will tell you that most of their companies are still around and they wrote $50,000 checks, right? Cultivation Capital Tech Funds have not had any of their companies to date go out of business. They have 36 investments to date, and none of them have gone out of business.
Wow.
And we've been around for 6 years. It's not as risky if you do the job and you have a process. And in addition to that, if you invest in undercapitalized markets and lower cost markets, most of the companies are more capital efficient. And a dollar goes a lot longer and a lot farther here. And so... Anyway, it's an educational process that this asset class is not as risky as they may think and can provide higher rates of return.
Cool. So is educating these folks about just, continuing to prove that it's not risky by doing it, or do we need to be
exits are the best education.
Exits, Get a lot of publicity around that, right?
Education solve a lot of problems. And here in the Midwest, some cities have done better at that than us. We've been really good at deploying capital. Now, we've only been really good at deploying capital since 2011, 2012, where our capital coming into St. Louis has been amongst the best.
Really?
But Indianapolis, Chicago, Minneapolis have all had a number of billion-dollar exits, and St. Louis hasn't had that billion-dollar exit. Although I like to say we've done pretty good. Worldwide Technologies, Express Scripts, Centene, Panera, all were early-stage companies, right? And not all of them raised venture capital, but we've always been very good here at raising and creating big companies. And so in the last decade, we haven't had that billion-dollar exit, but it's coming. And there's no question that's a game changer of the mindset of the investment community here in town.
Are there any companies that you can name that we should keep an eye on for that, or is that kind
of? We're very bullish on most of the companies that are in our portfolio.
Of course,
and some of the ones that you'll be hearing about. There's Gainsight, which was the fastest growing company in the Bay Area last year. Gainsight has 100 plus employees here in St. Louis, founded here in St. Louis, has raised $150 million in venture capital, doing very well. Jim Eberlin was the founder of that. Lockerdome obviously is doing very well. We're still very excited about that opportunity. A company called Noonlight that's here in this building, used to be called SafeTrack, is doing amazing things, and we're excited about that. Somersault, the women's swimwear company that's on the second floor here, is exciting. We really like what's going on at Clever Real
Sure.
Estate.
Yeah.
I mean, there's a lot of great companies that are, and in these examples, I'm talking mostly software and digital marketing companies, and not
Sure.
life science and biotech. There's
Yeah.
a great story there. It's just not mine to tell.
Fair enough. Cool. All right. Well, I think I'm getting the signal. We got to move on to bringing Eric on. So Eric, come on the show here. Eric is the of Bourbon Friday, and he's going to be introducing the bourbon we're drinking today. So what are we sipping on here?
So we're drinking Angel's Envy, and the reason why I picked this out is I knew a couple things about Ryan. He likes baseball and he likes wine.
Yep.
And so Louisville is famous for a few things: horse racing, bourbon, and baseball, of course, because of the Louisville Slugger. And Angel's Envy, where it's distilled at, is directly across the street from Louisville Slugger Park in Louisville. Huh. And additionally, this bourbon is finished in port wine barrels. So after it's finished aging, they put it into port wine, a little softer and a little sweeter.
Yep. And how long have they been making this?
Ooh, I don't know that for sure, to be honest.
I mean, so it's not a relatively new one?
I think it's fairly new, but yeah.
Cool. All right, well, as always, well done. You checked both boxes. I appreciate it. So I just want to have one final question, then we'll wrap things up here. So one thing I'm curious about, I mean, Eric and I both have kind of smaller companies at this point, obviously focused on growing. So I know you do a lot of mentoring of those kinds of companies. So what are maybe one or two of the things that you see that some of these early stage companies need the most help with? Maybe things that they're not seeing until they get a little bit of mentorship.
Well, I talked a little bit about building a bigger management team earlier.
Yeah.
Obviously, you don't have a lot of capital to hire them, but if you can give up some equity to get some help,
okay.
I think that's always important. I believe in a bigger team.
Sure.
But finding a good advisor to join your advisory board early on that can provide connections.
Okay.
It's amazing how one introduction to a potential customer can completely change the trajectory of a company.
Gotcha.
And I think when you look for advisory board members and good mentors, it's somebody that's got a network in the industry that you're attacking.
Okay.
Right.
Gotcha.
And so finding an advisory board member, finding employees that will work for cheap or for equity are some of the best things early on. Conserving that capital, but expanding the employees and going after a couple of key wins from a customer perspective are the most important things.
So just out of my personal curiosity, is there a percentage you generally give that person you bring in as kind of the first employee? What's kind of a...
Oh, on a first employee? I mean, it's... depends on how strong the role is, how big the commitment is.
Okay.
I've seen as much as 5 to 10% if they're key.
Okay.
On an advisory board member, I like to say 1/4 to 0.5% is what you give them.
Okay.
A board member typically gets 1%. An advisory board member 1/4 to 1/2. And again, depends on the amount of commitment. Depends on if they're making an investment. Things like that. But and when we make an investment, we usually build a 10% stock option pool for employees.
Okay.
And usually you can get some advisory board members out of that 10%, as well as give it to employees.
Gotcha. All right, cool. Well, thank you for the advice. I appreciate it. I'm getting the sign. I got to wrap things up here. So, Brian, thank you so much for joining us. Eric, great to have you as always. If you're tuning in, this is the Bourbon Friday show. We do it every Friday at 4:30 here at T-Rex. So thanks to T-Rex, EQ for hosting us. Thanks to Vanessa for being our producer. And please tune in again next Friday at 4:30 for the next Bourbon Friday show. Thanks for watching.
Cheers.